Good evening, everyone. Thank you for joining the call, the webinar. I am Saurabh Jain, the Chief Marketing Officer at Union Mutual Fund. On the call, we have our CEO, Mr. G. Pradeep Kumar, CIO, Mr. Harshad Patwardhan, and co-heads of equity, Mr. Hardik Bora and Mr. Sanjay Bembalkar. The agenda of today's call is that we'll give a quick update on the markets, both the macro and the micro factors playing, and where do we see the market going forward. After that, Sanjay and Hardik will take you through the funds update, and then we have a Q&A session. My request to all of you is that during the call also, keep writing in the questions, whatever comes to your mind, and we'll take all of them towards the end. Over to you, Harshad.
Thank you, Saurabh. Am I audible?
Yes, you are audible.
Okay. Good evening, everybody. Thanks a lot for joining this call. Thank you for your time. What we propose to do is I will maybe speak for first 5-10 minutes on the broader market outlook and hand it over to my colleagues Hardik and Sanjay, specifically to talk about two funds each, and then we will open it up for Q&A. I will request you to, we want this session to be as interactive as possible. So please, as Saurabh said, please keep sending questions. Before we look at 2024, let's just review what happened in 2023. If you look at 2023, Nifty delivered about 20% returns. Of course, mid caps and small caps did far better than that. If you look at 20% returns of Nifty, it's interesting that if you break it up into how much of it came from earnings progression and how much from re-rating. For Nifty, it's about 2/3 came from earnings progression and 1/3 from re-rating. Also, if you actually look at the month-wise data, you will notice that almost 13.5% of that 20% return in 2023 came in just 2 months of November and December. And the triggers, as you know, were one, probably the pivot of Fed, where they indicated that we probably have seen the peak rates, and also election results that we saw in the states that went to poll for assembly. But it's interesting that 2/3 of the returns of 2023 came in the last 2 months. If you look at the flow data, both domestic investors and foreign investors, institutional investors that is, bought roughly $20 billion worth of stocks in India. Now, if you look at the FII number, 40% of that actually happened just in the month of November and December. So, it's interesting how 2023 turned out to be. It's good to talk about it before we go to next year. Now, many of the positives that work for India, we believe will continue in next year also, 2024 also. Very strong relative growth of Indian economy. We saw the quarterly GDP number where there was a big beat. Now, it's very rare to see that kind of a beat on a quarterly GDP number. So clearly, in an absolute sense and definitely in a relative sense, Indian economy is growing very fast. If you look at corporate sector also, the expected growth is quite robust. So if you look at FY24 number, for example, the expected earnings growth for Nifty companies ranges, basically very high teens to even 20% plus handle. And in FY25, after such a robust year, we still see mid-teen kind of earnings growth. So again, both economic growth and earnings growth of corporate India continues to be very robust. More importantly, I would say the macroeconomic fundamentals of Indian economy really stand out in today's world. Particularly the twin deficit, which used to be a problem for India, high fiscal deficit and high current account deficit. Both of them have got significantly addressed. I'm not saying that we have reached the ideal level, but they are no longer considered as major risk when a foreign investor looks at India as an investment destination. In fact, as I said, we really stand out as compared to other countries. Also, the expected decline in policy rates, particularly in US, but in other geographies also through this year, should help that's definitely a positive for emerging markets. And India probably is the most favorite emerging market at this stage. So we will also gain from that. And I will not be surprised if the FII inflow number significantly exceeds what we have seen in 2023. Also, post-elections, we will see the broadening of the capital investment cycle. So far, if you see, a large part of the investment has come in from government, PSUs, and in real estate from households. We will see probably corporate investment also picking up from mid this year. What are the risks to this scenario? Clearly, volatile geopolitics is a big risk. And when you look around the world, I think there are wars being fought at least in 2 locations, and the tensions will probably rise after the recent Taiwan elections, even between China and Taiwan. So volatile geopolitics is something that we have to keep an eye on. The other important thing is clearly, the consensus is that there will be a favorable outcome of elections in India in May 24. So that definitely is a consensus and a base case. However, as you know, that policy continuity is a must for this positive scenario to play out. And the third risk I would say is there are pockets of euphoria, particularly in small caps and to an extent in mid cap. I think that definitely is a risk when you think about next year. On an overall basis, if you look at our fair value spectrum, and we have come out with a fair value spectrum for last several months. Currently, it's in a fair zone, and this fair value spectrum is essentially for Nifty. So at this point of time, we believe that the risk reward is more attractive in large caps as compared to mid caps and small caps. So, our recommendation to our distribution partners and through them to our investors is that if you are looking to invest in mid caps and small cap category, please do so in a systematic fashion, either in terms of long-term SIP, of course, that's ideal, but otherwise STP, at least over next 6 to 9 months. However, we will encourage you to consider lump sum investment in hybrid category as well as large cap oriented funds. So that's broadly what I wanted to say. Of course, I will come back if there are any questions. Now let me hand over the call to my colleagues Hardik and Sanjay. What we want to talk to you about specifically about 4 funds, 2 of which where we are, first one is clearly the Balanced Advantage Fund. Some of you might recall that we tweaked the strategy of this particular fund sometime in September. So we would like to report what the results of that change strategy are on performance. We will also touch upon our large cap fund, where we are very recently, looking to change the way we approach that fund. And also we will talk about our last NFO, which was the Innovation Fund, and also talk about Flexi Cap Fund, because that's a fund where our relative calls on large, mid, small can be executed better. Let me hand it over to Hardik and Sanjay. Over to you guys.
Thank you, Harshad. And let me start with the Balance Advantage Fund first. As Harshad rightly pointed out, we executed certain changes in our strategy. And as early as these changes were taken in September end towards October. So more than 3 months have passed since this new strategy has been in place. So just to run you through what the changes were, as opposed to being only focused on the fair value approach that we have now started using a blended model, a model which will take cues from both our fair value approach and trying to judge what the trend in the market is from a overall market momentum perspective. And over and above our fair value approach, we overlay a system of understanding where the momentum of the market is headed. Accordingly, we will then decide what the allocation of equity should be in our Balance Advantage Fund. So as you would have seen, for anybody tracking this closely, just to reiterate, what would have happened is the average allocation, net equity level allocation for the category has been around constant at about 55% for the last few months. But our balance advantage fund has seen its allocation go down to about 41% in October 2023 end. It was as high as 55% couple of months ago. So from 55%, we took it down to 41% in October 2023. And as of December end, the net equity allocation was at 75%. So we have been playing more actively on the allocation to equity. We are taking cues from both where the fundamental valuations are suggesting the market should be, and at the same time where the momentum of the market is, and based on that, where the allocation should be. We have backtested this strategy and found that it is able to generate, it has the capability to generate significant outperformance. The performance for the last 3 months has been in line with our expectations. And as you can see, our fund for the last 3 months has done better than the category average. So we are very hopeful with this change strategy. It has been working. Apart from this change, we have also increased the allocation to mid and small caps in line with what the category typically manages. So we have about 80% of our equity allocation in large caps and about 20% in mid and small caps in the net unhedged equity level. So this has also helped participate in the underlying market rallies that have happened. And with that, we are confident that we will be able to generate superior performance in the future. That is our hope. For investors looking to participate, we will also recommend even lump sum investment in this particular product at this point of time. Given that valuations are in the fair zone now, they were in the attractive zone by October end and somewhere close to the attractive zone in November end. But after the December month rally and the new highs that we have touched, we also find that a balance advantage product, which can basically move between equity and debt on behalf of the investor, will make a lot of sense for investors' portfolio. And hence, we are recommending even a lump sum investment if required in the balance advantage fund category. So that is the first product I wanted to talk about. The second product that we also want to talk about, as Harshad said, was on the Innovation and Opportunities Fund. This fund was launched in September 2023. And as we have promised, the product is being managed and created and managed on a true to label basis. Currently, we have about 70% allocation to small caps and mid caps. Large cap allocation would be something close to about 23-24%. So compared to our own benchmark, which has the reverse situation, where the allocation to large caps is 76 and the allocation to mid and small cap is 24, we have an opposite position. Hence, the active share is very high. We don't have any of the large benchmark stocks in our portfolio, since they do not fit in line with the innovation and opportunities theme that we are trying to play. So we don't have any stock from the oil and gas sector. As you would see, we don't have the large private banks. We don't have any position in large FMCG companies. Even the large cap IT companies are absent from the portfolio. This difference in allocation to mid and small cap versus large cap, and choosing to avoid some of these top benchmark stocks since they are not playing onto the innovation theme, and being more aggressive on stocks that are actually playing on the innovation and opportunities theme, has resulted in close to 90% active share for our portfolio versus the benchmark. So to that extent, this product is truly complementary to whatever product investors would typically be holding. It is a different product. The objective of the scheme and the product is to basically benefit from underlying changes in the economic structure of different businesses and sectors, trying to play through an innovation-led business model or businesses that can support that innovation. So that continues to be a large part of the theme. Just to summarize, we have played different levels of newness in the particular portfolio. So new products and services, they make up about 25-26% of the portfolio, and another 20% is played through companies that are offering products to a new or basically offering services in a new way. Some innovative approaches used in the way they are offering their products and service. But more importantly, we have also identified a host of companies that are facilitating this innovation and these opportunities in the country. So this totality makes up more than 75% of the portfolio. Companies that are providing innovative products or are conducting business in an innovative way, or thirdly, that are supporting this innovation. So this continues to be a large part of the theme. In this fund, however, we will recommend investors, given its allocation to mid and small cap, and as Harshad said, that we find relative attraction in large caps currently compared to mid and small caps. We recommend investors to participate in this category, in this particular fund, through an SIP route or a 12-month STP. That would be advisable. We are not encouraging lump sum at this moment in this particular fund. With that, I would request Sanjay to talk about the other products that we are talking of.
Sure. Thanks. Thanks, Hadik. So I'll talk about FlexiCap product first. So this is, as you understand, this is a FlexiCap strategy product where we have all large, mid, as well as small category, and we try to play these categories dynamically whenever, from our understanding, whenever there is a risk reward is favorable in each category. This is a diversified product present across all the 11 GIG sectors, and fund manager has ability to not only allocate money across large, mid, and small categories, but also through sectors wherever the risk reward is favorable. As Harshad was alluding, in 2023, we started year with the slow trend, but however, as the year came to the end, in November and December, momentum of the sector as well as the market really picked up. So from October, if you recollect, from October 2021 till March of 2023, that was quite a lull period for mid cap and small caps. We would have seen in our FlexiCap product at the start of the year in January 23, we had 72% allocation to the large cap, and mid cap and small cap were having 16% and 5% allocation respectively. But as we came to the June period, our allocation in large cap reduced from 72% to 57%. And mid cap category grew from 16% to 19.8%, whereas small cap category grew from 4.9% to 17.9%. So this dynamic play of risk reward in the mid cap, small cap, as well as large cap category was played through different allocations. So dynamically managing the allocation in these market cap curves. Not only that, we also changed our allocation dynamically through the sectors. So consumer durables or industrials, which we were quite positive on, where we think that manufacturing-led growth is going to benefit quite a bit to the industrial sectors, we increased our allocation materially in these sectors. And that played out in 2023 first half. By the end of December 2023, our allocation to large cap is 62.4, mid cap is 16%, and small cap is 15%. This fund is also having a higher active share as such. So currently our active share is around 53%. So though BSE 500 is a quite diversified benchmark, we have high active share in this category in the FlexiCap product. As currently large cap is almost 60% plus levels in this product, we recommend that investors who want to come in the lump sum or who want to allocate money in the current context, we think that this product is well suited for the investors to allocate from their current risk reward generation perspective. And second product I wanted to talk is on the large cap. So large cap is a age-old category, and we have our product operating in this category very true to the mandate. When we say true to the mandate, that means the large cap allocation, if this product is significantly higher, and there is no small cap allocation in the large cap fund as such. This category has also seen a dynamic allocation across 11 GIGs sectors. So this is a diversified product, again, mainly managing the allocation in the large cap and mid cap through the large cap and mid cap curves. And there is no allocation to small cap in our large cap fund. Recently, we looked at this category afresh, and as Hardik alluded, that we have changed our allocation, our strategy in the Balanced Advantage Fund, and the new strategy for Innovation Fund is also unveiled. We are undergoing the change in the large cap fund large cap fund strategy as such. So here we are going to increase our active allocation to the above average category over a period of time. So generally this fund you will see in 2024 will have higher active share than the category averages. There will be higher sector deviations and stock deviations than what we used to do in past. We will be using this 20% differentiated allocation. So this category has 80% allocation to the large cap stocks, and balance 20% can be managed dynamically. And we would look to exploit as much as possible from this 20% allocation in a non-benchmark high conviction bets from our perspective. And then there is a bucketing framework, which strategic, tactical, options, and defense, which Harshad had talked earlier in earlier discussions. Those bucketing framework will be actively sought after and actively managed in the large cap category as such. So currently, as we speak, this portfolio is having 88.5% allocation in the large cap. Mid cap is having 7.9% allocation, and there is no allocation to the small cap category as such. All the names in this fund undergo a very rigorous fundamental analysis at our end. We look at companies which are growing faster than the industry and managed by decent and quality management as such when we are allocating our allocation in the large cap fund as such. Again, current risk reward analysis suggests that large caps are favorably positioned versus mid cap and small cap in our fund house universe, and we believe that even from the current context, large caps are valued at they are in the fair zone of valuation. So we believe that any investor who want to allocate from the money on the lump sum basis, this again suits quite well for the investors from the risk reward perspective. Any investor who want to allocate from 3 to 5 years perspective, we believe that this category has a decent fair risk reward from investor perspective. So this is where I will stop, and I'll request Saurabh to take Q&As.
Thanks, Harshad, Sanjay, and Hardik. Pradeep, can I request you for closing comments before we move to the Q&A?
Yeah, sure. Thank you, Saurabh, and good evening, everyone. I hope you all found the insights given by our team, Harshad, Sanjay, and Hardik, to be very helpful in this environment. I think it's in the minds of most people, distributors and investors, as to how to tackle the current market and which direction to really turn to for investments. And I think from that point of view, our views have been quite clear in terms of where we see relatively better value. And especially, we also want to emphasize that as a fund house, we are very, very conscious that it's our job to deliver good value on all our products. And one of the things that we really wanted to convey to you today was that we are closely monitoring the performance of our own funds, and where we are seeing the need for improvement, we are always the first one to really spot it and take action. And some of these actions that we have taken, it's already showing in the performance of our funds. And I think going forward, you can expect really good, consistent, superior performance, which is what we always try to achieve. Interesting markets and also challenging markets, but we are definitely doing our best to make sure that we protect your interests and shield our investors from the volatility to the extent possible by actively changing the allocation, for example, in the flexi cap between large, mid, and small cap funds. So and similarly in BAF also, we have taken many steps which we think will help the fund to perform quite consistently in future. So really appreciate the support from all of you, and thank you for the patient hearing. We will continue with our efforts to deliver good value and good performance on all our funds. And please feel free to share any questions or thoughts that you may have. Thank you.
Thanks, Pradeep. We move to the Q&A session. So the first set of questions is from Mr. Amit Gupta from New Bombay. What are the outlook on the elections in India and US in 24 and the impact on the market?
Okay, I will try to address that. I think it's very difficult to say with any degree of conviction exactly what will happen in the elections. Although, as I said, I am talking about Indian elections. What I tend to rely on a lot is what the surveys say, and I think probably in a week or two we will get sort of the most consistently done survey, that is the India Today's Mood of the Nation survey. It comes out twice a year, and the next one is expected in mid-Jan sometime. I think that probably will give you a good picture at this point of time. What are the voters thinking? But I will not really hazard a guess and put say with a great deal of conviction what might happen. But clearly, the base case seems to be continuity. And for the positive scenario that I talked about, for that to come to fruition, clearly the policy continuity is important. As far as US elections are concerned, it's a long cycle. I think we just saw the first primary of the Republican Party being held last night. We don't know exactly how that's going to play out, but I would say that US elections are less relevant for our markets. Clearly, our own elections are much more important, and there the base case or the consensus seems to be comforting at this point of time.
Thanks, Harshad. The next question is on the valuation. So the question is, compared to historical valuations, where do we see India, US, and China markets compared to historical valuation?
Okay, again, I will attempt this question. I don't have the data for the other markets. As far as Indian market is concerned, if on a forward basis, Nifty is trading at around at a premium, I would say. Can you hear me, Saurabh?
Yeah, we can hear you now.
Hello, Saurabh, can you hear me?
Yeah. Yes,
I think
we can hear you.
Connection got disrupted. So so it is definitely at a premium to long-term trading averages. Okay, but let me say that valuation always has to be seen in the context of where are we in the cycle in terms of earnings growth cycle. And if you look at our growth of India as a whole, and more importantly, corporate profit growth has been doing very well. The return on equity, which was close to 12-13% a few years ago, is now close to 16%. So we are in an upcycle. And when you look at that, I don't think the current valuations, particularly at the Nifty level, are something to be worried about. As far as US is concerned, I don't have the exact numbers, but US also is trading. The markets have done well, and it's trading at premium to the long-term averages. China, on the other hand, is probably a market which is trading far below their long-term averages. So that's how I think all these three markets are positioned right
now. Thanks, Harshad. The next question is on the innovation fund. From the innovation fund, we have removed fertilizers and agrochemical sectors, and we have added a new sector, beverages. Can you shed some light on this?
Yes, I'll take that one. So as far as the choice of stocks is concerned, it's not so much to do with what sector that particular stock fits in. It is whether it fits into the overall theme that we are working on. As you know, when we have spoken to our distributors, all the investors, we have explained that we are broadly trying to understand how innovation opportunity works in 6 different buckets. One of the bucket is also new markets and new customers. Some of the stocks that get added recently were basically catering to that particular opportunity, where a new market was currently being added, and that leads to a new opportunity. So as we have been talking about the element of newness in the innovation fund, something new has to happen for the companies to see a bigger growth in their fair value, to see a bigger appreciation in their stock price accordingly. When we are talking about some of the companies which we add in this particular bucket of new customers and new markets, that is the incremental change that happens in their business model. Maybe earlier they were only supplying in one particular territory. Now a new customer segment or a new geography has been added, and that results in a significant increase in the overall market opportunity. So when we are looking at companies which are fitting into this bill, they are also part of our portfolio. And the companies whichever company goes into the portfolio will have to fit in either of these 4 major categories and 6 subcategories that we have. I already spoke about them in detail, but The call hence is not taken from a sectoral perspective. The call is taken from the perspective that whether a particular company meets these criteria and hence can report a very strong business growth in the coming years.
We have one more question on innovation fund, but I would like to say that we cannot talk about stocks. So basically, the question is that why have you removed 2 stocks and what the other 2 stocks? So
I can generally talk about the addition and deletion of stocks
Okay.
without naming any stock.
So I think there have been 2 stocks which we have removed.
Yeah.
Right. So
So
can you give
yeah.
some update on that?
Yeah. So any stock that goes out, the main reason for it going out is that we believe that the overall fair value for the company is not going to grow at the pace at which we initially envisaged it to be. When the companies are exited, there is either some derailment in that growth potential or the overall innovation opportunity that we were basically expecting the company to benefit from. If our opinion changes on that particular matter, the company will no longer be fit to be part of this particular portfolio. There have been other situations also where some stocks have been reduced in weightage but have been retained here as long as the overall theme is still at play. If the company continues to benefit from the innovation theme and there is only a minor setback or some very sharp run up in stock prices, we might reduce the position, our active weight in that particular stock, to either book profits or to reduce our level of conviction, reduce our level of position. But a complete exit means that we are no longer confident that the innovative theme or the opportunity that the company was trying to benefit from, whether it will continue to benefit the same way. So the exits have happened primarily for this reason, either profit booking or reducing our bet to reduce maybe the extent of overweight if we feel that the current opportunity is not being played. But the exit happens only when we feel that the overall story is not playing out.
The next question is on the overlap in our portfolio. So Union FlexiCap and Multicap are having an overlap of 69%. FlexiCap and Focus Fund is having a 54% overlapping. And FlexiCap and the Value Fund is having 48% overlapping. The question is why our overlaps are so high?
Maybe I can take this.
Yeah.
Yeah. So we look at funds from the investor mandate perspective. Different funds have different mandates. So for example, FlexiCap is having mandate to allocate into large, mid and small category with the BSE 500 benchmark as such. If you look at value on the other side, is more focused on the value oriented company where we think that currently there is a less execution risk in these companies and the valuation of these companies is very close to the fair value. So that is the kind of thought process which is deployed when we are deploying money in the value discovery product. And Multicap, as we all know, is having 25% minimum allocation in large, mid as well as small categories. However, balance 25% is available to the fund manager at their discretion. Eventually what happens is that when fund manager is allocating money across the market caps and across 11 jigs, whenever there is an interesting idea which fund manager gets, and if it's very convincing and very attractive idea, it gets allocated, money gets allocated across the schemes if that idea is fitting the investor's mandate in the true spirit in which the investor has given the money for. So sometimes it may happen that these names may overlap from the sectors as well as from the market cap opportunities which are available and throughout the funds from FlexiCap as well as on the multi-cap category. However, as we all know that even if you look at from the allocation perspective, FlexiCap is having 67% allocation to the large caps, whereas from the multi-cap category, allocation is less than 50. So it's 40 to 43% allocation into the large cap category. That itself is a very big deviation from the investor's perspective, that when we are looking at the risk reward or the kind of risk analysis as well as the reward analysis which investors are doing. So there will be certain large sectors as well as large stocks in the benchmark where fund manager may not want to take a very significant deviation from those stocks, and that's why they are present in the particular fund as such. But I'm sure, as you would have seen funds over a period of time, there will be material overweight or underweight when you are comparing the allocation or the bet which you are taking on those particular stocks, depending on which fund you are looking. So the same name may be there in the flexi-cap as well as in the multi-cap, but the kind of bet which fund manager is putting in that same name in the flexi-cap category as well as in the multi-cap will be materially different. And that's why this active share analysis, what we do, as well as if you look at the overlap may be very, very different. If you look at particularly in the mid-cap, small-cap category, and if you look at other diversified fund as such.
Thanks, Ajay. The next question is, what is your, the expectation on the alpha that can be generated in innovation fund? Yeah, so I take that. If you look at it from this fund perspective, what we are positioning this fund is that the best of the ideas, which also have innovation running as a theme, has been put in the portfolio. These are all companies where the growth is very high, expected growth is very high, and our conviction levels are also very high. Yeah, some of the stock ideas may or may not work, right? And we will change it like we have changed the portfolio. But if I have to look at a risk and return profile, I would rank it as higher than a small cap fund. Hardik, Sanjay, you want to add anything on the?
Yes. So no, so Saurabh, I think you covered it well. Only point that I will add over and above that is the reason why also the risk is high in this fund versus the small cap fund or the mid cap fund is because these companies are doing something that is very different than the companies that are their counterparts in the industry. Hence, there is an element of, as we said, newness in the way these businesses are carried out. The outcome of this is that there is limited or relatively lower understanding on how these businesses should be valued and how fast or how long they can grow at this fast pace. Because of this lack of understanding, or I would say relatively lower understanding on the street, as far as these businesses' potential is concerned, there will be volatility, inherent volatility in the stock price. Now, the way we are trying to hence benefit, notwithstanding this volatility, is to have significantly better growth potential for the companies we own. So the growth potential for the companies in this particular portfolio is invariably higher than the growth potential of, let's say, our companies and portfolio companies in the mid and small cap category. So given the higher growth, we believe that it should justify this volatility. That is the agenda with which we are operating. And that is one more point I can add, that the portfolio level growth is going to be much higher in this particular scheme compared to our other schemes.
Thanks, Hardik. So there are multiple questions which I'm combining. Basically, there is a worry on the valuations. So there are multiple questions talking about market touching all-time high, expensive valuation. Many questions are talking about valuations on small mid cap, which we alluded to, but I think it makes sense to talk about it once more. Then there's a query that should I shift all the money from equity to BAF kind of product at these levels? Should I get out from small mid cap fund, or if I have to put fresh money into small mid, what is the right strategy? If STP, for how long the STP? So these are all market valuation concerns. There are multiple questions. So I suggest we address them once more. While we did allude to it, some part of it, not all, I think it makes sense to talk about it once more.
Okay, Saurabh, I will attempt that question. And Hardik, Sanjay, please do add if you have, any other points. See, valuation is always an important element during, discussions. But let's remember one thing. Ultimately, the stock prices are always set by a marginal buyer and a marginal seller, right? And of course, our job is to evaluate how does the stock price look as compared to the fundamental or a fair value. But the fact of the matter is that it's the incremental buyer and seller who sets the prices, market prices. And therefore, flows is an important component when it comes to understanding the prices and the current valuations. And as all of you know, for the last, there has been if I can call it, a tectonic shift in the way the supply-demand dynamics or the demand dynamics had changed in the Indian markets. Some of you who have been in the industry for a long time will recall a period when everybody, or most people, market participants, were fascinated or were completely fixated on what the FIIs were doing, because FIIs were such a big component, big part of the market, that they used to move the market depending on when they are buying or when they were selling. What has happened over the last few years, and our distribution partners, all of you have seen that from very close quarters, is that the salience of domestic investors had significantly improved over the last few years, 3-4 years, post-pandemic in particular. Investors coming directly through various online brokerage platforms, and more importantly, investors coming through mutual funds and also other institutional mechanisms. So if you look at the fund flow basis, domestic investors have clearly emerged as very, very important component. So, if you look at from a chart perspective, I can't really share that chart with you right now, but the domestic investors have become very, very important as compared to the foreign investors. Some of you will recall over the last 2-3 years, there was a period of, I think, 8-9 months when foreigners sold, I think, close to $35 to $40 billion of stocks in the Indian market. But all of that pretty much was absorbed by the domestic investors. So our market, I would argue, that had structurally become more positive because there are more legs to stand on for our markets. We are not over dependent on foreigners. As a result of which, what was a sort of fair valuation, I'm not saying from a fundamental perspective, but from a demand supply perspective, I think it's understandable why the valuations today are higher than where they were earlier. This is somewhat akin to obviously there is a bit of an exaggeration in the parallel I'm giving, but it is somewhat like property markets, where in select pockets we see prices going up because there is much more demand compared to supply. So that is a bit of what is happening in our markets also. So yes, the valuations are high. What we as managers of money on behalf of others do is that we basically look at it from a relative perspective. Because, in our open-ended mandates, we have to be fully invested, because that's why people give us money to invest. What we do then is to see on a relative basis, where is the risk reward better? So we are basically approaching the markets like that. In my memory, over the last 20 years, there were actually only 5 or 6 instances, or maybe even fewer, where the market appeared, cheap from an absolute perspective. Okay, so that was, the last time it happened was immediately after COVID pandemic. Before that, 2018 was a period when mid caps and small caps appeared very cheap in an absolute perspective. But most of the times we have to do that analysis on a relative basis, and which is the reason why we mentioned, and both Sanjay and Hardik also said, that we are finding things a little more attractive on a relative basis in the large cap space as compared to mid caps and small cap space. So that's how we have to approach markets. We don't have direct control over where the valuations are. That's a function in the near term of how the flows are.
Thanks, Harshad. Sanjay, Hardik, you want to add anything?
Yeah. So I'll just mention a couple of things. See, if you look at last 5-10 years, a lot of foundational work from the government perspective on the legal side, on the GST demo, which we have been talking about for now, lot many times, is now done. And now we are looking at a new growth areas like electronic manufacturing side, on the industrial side, let's say new areas or avenues are coming, like mobile manufacturing is now picking up like anything. So India is changing. That is fact of life, and we have to put that in context. So for example, if you look at, let's say, last 10 years time, SUV mix, let's say number of sports utility vehicles which were selling was 30%, and now it is 60% of the overall pie. If you look at even from the labor force participation, earlier labor force participation, which was 38% last decade, is now 42%. And those areas which are actually structural in nature from the economic perspective are changing quite a bit. If you look at the data from the CMI or the kind of a capex cycle which we are talking about, when we look at how many projects are being declared, all the data points are indicating that India is now at a cusp of a new cycle where a new capex is going to start, a new kind of investments are likely to come through, and the existing capacities which are, let's say, underutilized in earlier decade are going to be either fully utilized or the utilization is going to increase. And the effect of all this is that the existing machinery or existing capital which was deployed in the businesses, which was less utilized and was generating X amount of profitability on that, is going to generate at least some higher than X. So 1.2X, 1.3 times the X is going to be the marginal utility of that money which was deployed in earlier cycles. And the impact of this is that when we talk to you about the ROE or ROCE of India, that ROE, ROC profile of India is going to get elevated over a period of time. And that is driving the overall frenzy from the FII side or from the investor side to capture maximum of this kind of growth which is going to come through in India. And we believe that that's why, as Harshad alluded, though PE multiples are looking slightly higher, the kind of runway which we are seeing is also looking to be more promising than what it was in past. And that's why when we look at from the fair value perspective, we think that it's in the valuation is in the fair zone, though it's looking slightly on the higher side when we look at one variables like PE or price to book. That's why we always mention that you always look at multiple areas when you are looking at the valuation from the market perspective for India. And when you are investing in Indian market, as Harshad and Hardik mentioned earlier also, particularly from the, let's say, the events which are lined up in 2024 going to be mega event year, we have to look at from the risk reward perspective. So please stagger your entry when you're looking at, let's say, mid cap and small cap themes from the 6 to 9 months bucket. And that is the kind of time frame which we are looking when you are investing in the mid cap and small cap category. Whereas from the large cap category, though staggering is always better, if there is a compulsion or increase in allocation is warranted, one can look at for large cap oriented funds from the immediate basis or from the lump sum category, lump sum investment basis.
Thanks, Sanjay. Also just to reiterate, there's a question on should I switch all money from equity to BAF? I would not suggest that. And you should be looking at the client's allocation to equity, what his risk return profile is. And I would never say it would be wise to get out of one asset class completely and move into the hybrid category. So that's a very extreme call. The next question is on the solution-oriented fund, so which is children fund in retirement. So there are two questions. One is how differentiated are we going to be the portfolio compared to any flexi or multi-portfolio, the children and the retirement fund? How do we differentiate over there? And second is, have we built up the portfolio of children fund and what has been our strategy over there?
Maybe I can take that. So when you are looking at categories like children's fund as well as the retirement fund, these are solution oriented products. And as you understand, there is a specific lock-in for these products. When investor is entering into these products, there is a specific lock-in for the investor. And that's why, particularly when we're looking at these products, there are two differences which are very key for versus flexi-cap category or multi-cap category as such. One is the higher allocation to the mid-cap and small caps, which are high growth high growth oriented investments. So higher allocation to mid cap and small cap is warranted in these products because the investor horizon is also longer than what one is looking from the flexi cap perspective. That is point number one. So you will see that in the both the categories, our mid cap and small cap allocation is higher than the flexi cap category as such. And second is on the cash calls. So these are typically where investor has ability to take cash call is in the funds which you don't have any lock-in. And when there is a lock-in, particularly for the 5 years or up to 18 years of age, we believe that cash call can be taken by the fund manager on behalf of investor when investor is not able to take cash calls. So this is the another differentiation in the children as well as in the retirement product, that whenever warranted, whenever valuations are looking quite stretched, we will not hesitate from taking any cash calls in these two categories, particularly in the retirement fund as well as children's fund.
Thank you, Sanjay. The next question is again on the innovation fund. Are we slowly moving towards from small cap to the large cap? Looking at the portfolio, is it that we are shifting the portfolios from small to larger cap?
No, we are not really shifting anything from small to larger cap by any, let's say, design. What is happening is that some of the companies are reporting better numbers or are seeing a bigger increase in their stock price. So there has been some passive movement because of which the allocation to large cap has increased to some extent. In some cases, maybe there are some developments or certain companies that got added in the portfolio. They happen to be in the large cap category, but the choice of whether the company gets added and it happens to be a large cap is not based on, again, on which market cap category it is in. It happens because incrementally a new idea came, which happens to be fitting not only the innovation criteria and the opportunity criteria that we have set up, but also part of the large cap category. So any change that you are seeing is not done with the idea of having more large caps per se or reducing our position in mid and small caps. So the simple answer is no. Any change is always subject to it matching the initial objective of the portfolio. We will not make these tactical changes because we are anyways asking our investors to be more tactical in terms of their allocation. So we are not recommending lump sums and SIP so that you don't have to get bothered by the volatility of the portfolio to whatever extent possible.
Saurav, can I just add one comment?
Yes,
to
please.
what Hardik said? Just adding to what Hardik said, that's exactly how we operate. We will not buy something just because it is a large cap. It has to meet the newness criteria. And you should expect that this fund will overwhelmingly be a small or mid cap kind of a portfolio, because frankly, that's where we find most of the newness ideas, where, needle movers. So, and we have discussed this issue before, but large companies also claim, and legitimately so that they are also doing innovative things. But what is important is that whether that innovative thing that they are doing, whether it moves the needle for the overall value of that business. And the answer most of the times is no. And therefore, this portfolio, there will be some changes that will happen, which will be more from a bottom-up perspective. But it will continue to be an overwhelmingly mid and small cap oriented portfolio.
Thanks, Harshad.
I just wanted to maybe add one data point for explaining this point that Harshad made. The large cap benchmark, the benchmark weighted market capitalization is close to 6 lakh crores. And the average market cap of the large caps in our portfolio is close to 1.2 lakh crores. So it's not that when we are buying large caps, we are going and buying mega caps. We are buying companies which would have recently become large caps, or where the runway for growth is very large. They have tactically come in the top 100 companies by market cap that range, but they broadly match the innovation theme. And as Harshad said, that we are sticking to the overall objective of this theme.
And Hardik, correct me if I'm wrong, but we do not own any of the top 10 stocks in the benchmark, right?
That is correct.
That's very unique, I would say, for a portfolio or a fund where the benchmark itself is, NSE 500 and very, very top heavy, but we don't own any of them because they don't meet our criteria.
Well, the next question is that recently there was a news on PI Industries. How does our investment process framework react when there are negative news on the stock, especially in the case of PI Industries?
See, of course, we will not be able to talk about stock-specific names. They could or could not be part of our portfolio, and our actions could be. But I'll tell you how we look at it. As you all know, we have our internal fair value approach, which we use to understand how a particular development affects the first step is to understand the impact on the fair value. And this could be in many ways. There could be a regulatory change. The RBI tomorrow could ask that the capital adequacy ratio for housing finance companies have to be increased, or tomorrow there could be a requirement that a certain particular sector or a particular drug goes under price control. So companies selling that drug will see some fall in their product prices, the realization. What we first try to understand is if this impact is built into the fair value, what should be the downgrade in the fair value? If the downgrade in the fair value is not meaningful, then we need not necessarily act into the stock. But if the downgrade of the fair value is structural, where let's say some changes happened and we believe that the structural return on equity and the growth potential of the business has been affected, or where there can be a meaningful, the sensitivity analysis shows us that if some of this development were to play out to its fullest extent, the swing in the profits could be very wide. Then we take a call where we try to reduce our weightage. Either we reduce our active position in the stock, where we say we don't have the same level of confidence as we had before the development, or if we believe that even with a low probability event, as recently we have started even looking at another aspect of how the near-term returns can be impacted. We do a probabilistic analysis of understanding what can be the bull case and the bear case on any stock based on our own fair value estimate. While our fair value tells us how the next 5 years are going to play out, we also try to understand how the next 1 year or medium term can play out. If the bear case scenario, even with a low probability, indicates that the deterioration could be very meaningful in profits, then we might change our portfolio position. We might even exit the stock. So to summarize, we have our eye on the long-term fair value and how structurally things get changed. And we also have an attention on how this developments, bear case or bull case scenario, the sensitivity analysis tells us how bad can things be. If the answer is that even with a low probability, the loss could be heavy, we will meaningfully reduce or even exit the position to avoid any material underperformance in the near term. But I must say that changes like that are not that common. We have recently seen some of these developments happen maybe in relatively quicker succession, but such damning movements or developments in businesses are not very frequent.
Thanks, Hardik. There are a few questions on sectors. So the IT sector results have been a surprise for many people. What's our view on the IT sector post-result?
Okay, maybe I can take that. Yeah. So, see, IT has been actually very classical case in the business cycle kind of a product, where a business cycle for the fund for the sector is changing quite quickly. So as we see from, let's say, slightly backward from 2020, we suddenly saw work from home and overall demand for the IT product growing quite substantially in 2020, 2021, 2022 period. And that led to significant re-rating of IT companies, even in the Indian, from the Indian available IT companies as such. And in 2023, we saw that higher demand for the talent, as well as higher demand for the overall workforce, led to higher cost for these companies, leading to margin compression, as well as when the slowdown happened in these companies, when growth normalized, that led to substantially lower growth number for these companies, leading to de-rating of these companies in 2023. from 2022 half to 2023 period. In 2023, we changed our strategy from underweight to equal weight IT once we saw that now the prices are already capturing in the lower demand as well as the P multiples have compressed, and the kind of risk reward is now much more decent than the earlier very less risk reward for the investors from the IT sector perspective. That's why we increased our allocation in IT from underweight to equal weight category. Currently, as we are seeing numbers, if you look at from the number perspective, there is not a significant change which has happened from the IT company's result which has come through. So numbers are not yet indicating significant green shoots from the recovery perspective. So if you look at US growth, or if you look at the workforce added by all these companies, is still not pointing towards the positive direction. However, what has changed is the two things. One, the commentary is indicating that now demand has bottomed. And second, IT sector particularly has a very high correlation with respect to US economy and what US monetary policy direction is likely to take over a period of time. And as we see, as Fed is indicating that there will be pivot and there will be a reduction in the interest rate over a period of time, leading to softer monetary policy. And that may lead to changes in the fortunes for the companies in US and Europe is getting priced in the from the current market perspective. So as Harshad alluded, the marginal buyer and seller are indicating that the optimism in the US market needs to be priced in, and that's what is getting priced in the IT companies valuation as such. So from the long-term perspective, if you look at these companies, are very quality companies. They have delivered significant value creation for Indian investors. They are gaining market share. Indian IT workforce and the kind of quality of management which we have in IT sector has delivered phenomenal results for not only investors but also globally with respect to the businesses, or the kind of value creation which they have done for the businesses or the clients as such. So we think that this is a fantastic case from the long term perspective, that value creation is likely to accrue over a period of time, and this pivot in the monetary policy is getting priced in by the investors in the current context. So in the diversified products, we are equal weight on the IT business, and we are watching it from the very positive side. Now this hope or this narrative story has to get converted into numbers. So unless this shows up in numbers in next 1 or 2 quarters, I think the next wave of re-rating for IT will take some breather. If that shows up in numbers, I think the next level of re-rating we can think of.
Thanks, Sanjay. So quickly moving on to other sectors. So what we'll do is we'll do a rapid sector view. So I'll name out the sector and you can start by saying whether we are overweight or underweight. So IT, we are equal weight. We are neither under nor over. So, and then give a very quickly outlook on that sector. The next one is pharma and healthcare.
We are equal weight, pharma and healthcare. We believe that this particular quarter can report relatively decent growth for the companies under the universe that we have. But the reason why we are not overweight is because in the coming year, because of the challenges on the logistics side, there could be certain cost-related pressure that could come through for the companies. Margins probably could be facing some headwinds. So we don't feel that we've already made decent profit on some of the portfolio positions, but we don't feel that valuations are very appealing. So to that extent, given the fair level of valuations, we are maintaining an equal weight position.
BFSI.
When we say BFSI, we have to break it up, unfortunately, because it's a relatively bigger basket. But I would say we are slightly overweight on the sector and primarily playing it through, let's say, PSU banks, certain NBFCs, and financial services in general. So capital market plays. In some cases, we've also played through insurance companies. So this is the bigger play. What we have been equal weight or underweight actually in the space is private banks. We've been playing it slightly more selectively. The entire basket, we might not be having a big overweight. In some particular categories, there are not enough opportunities to play the private banking space. So the December month portfolio would show that PSU banks or certain NBFCs are a bigger preference in certain schemes and private banks are in others. The way we are playing this particular play, Saurabh, is that we are looking at which pockets of the industry of the economy where the growth rate appears to be strong. So unsecured lending, as you know, was highlighted to be an area of concern by the RBI. And even there were some developments from the industry participants who had tried to go slow on this piece. So that is one sector where we have taken a much more underweight stance. Any companies in that space, we are trying to be underweight, and that is how we have positioned it. That's what you would see on a December portfolio. Also, the other area where we are a little cautious is maybe on the private banking side, because maybe PSU banks could report relatively better growth. There are certain pockets of good valuation in private banks. We are playing those banks more aggressively, but the entire private banking space might not appear as attractive as some of the PSU banks, for example, do, given the growth opportunity and the high ROEs. And of course, NBFCs, which are also into secured lending, appear very attractive to us. Not the unsecured lending part, but the secured lending part. But if we were to talk about our biggest weight in the banking financial services industry, then financial services, which are ex-lending businesses, primarily in the capital marketplace, whether they are AMCs or whether they are discount brokerages, or whether they are other companies which are helping us participate in the capital marketplace through, let's say, RTAs or other such intermediaries, we are playing those themes more aggressively. Finally, I don't want to leave out the small, mid and small cap category of microfinance. We don't have too many names, in fact, hardly any names in the large cap that play that theme very aggressively, but in mid and small cap, we are playing microfinance theme also.
Thanks, Hardik. Specialty chemical?
Underweight currently. We don't feel that there is any reason to get constructive on the sector yet. Yes, valuations had become very attractive somewhere in December. There was a short spike in valuation as well. But given the fact that large part of the sector is export oriented, and again, just like in pharma, the challenges in the Red Sea will also affect the business momentum for this particular sector. We are not yet going aggressive on the sector, and we are underweight, whichever category we look at, but they are more mid and small cap sectors.
Okay, there's a follow-up question. I'll just take it along with this specialty chemical. So there's been some news article about the dent it can have on the export, the ongoing trouble in the Middle East. So what's our view on that?
Clearly that we are also cognizant of the level of impact it can have on businesses. That is also the reason why we are looking at companies which are dependent on the local economy. So when we look at our consumer discretionary, consumer staple names, or even the lending companies, the financial services space that we said we are overweight, slightly overweight, these are the areas. And more importantly, I would say the other sectors like capital goods, which are dependent on the local economy picking up. And as Sanjay in very much detail highlighted how the capex and the investment theme in the country is going to play out. We are looking at sectors where this risk of exports, movement of goods from this part of the country to the Western world, that risk is limited. So we are trying to, of course, play it more safely on that particular area. We don't know how bad things could get before they get better.
Okay. Auto?
So we are quite positive on the auto sector as such. So if you look at within the consumer discretionary bucket, auto is one bucket where we are, I think, much overweight positioned across the portfolios, across market cap as such. We find a lot of attractive opportunities in this area. So just to give you one data point, let's say urban consumption, so urban wage growth as such has grown almost like double digits, 17% wage growth we saw for financial sector as such during last year, whereas rural wage growth is still at 1% level. So urban oriented premium consumption theme is something which we really like. Within that, auto fits quite well for us. It's a interest rate cyclical sector as well. So as we are on the verge of interest rate reduction over next 1 or 2 years, we think that auto is having very significantly positive risk reward for the investors. We are very positive on the auto sector, including auto ancillaries.
Thanks, Sanjay. So apart from BFSI and auto, what are the sectors we are overweight on?
So recently we have seen some changes across our portfolios. There are since one of the question was also indicating market valuations are slightly increasing or they are looking elevated. We are also looking at different pockets, going deeper into each of the sectors to identify where are the value or risk reward ratio is attractive for our investors. And certain pockets which I have found in recent few months and which has helped our portfolios are two particular pockets. One is on the real estate side. We find real estate to be quite attractively positioned at the moment. We think that demand supply scenario is quite favorable. Real estate has, as a sector or as an asset class, has not delivered material returns over last decade, and that may be due for changes. And that is one sector which we find quite attractively positioned from the stock market perspective. Second area which we have also found out is on the regulated utilities. So though regulated utilities sector has multiple areas like gas utilities, power sector, there are T&D side power sector utilities. We think that particularly on the power generation, as Indian economy is poised for a significant growth over the next 5 years, 10 years period, what has happened is that this sudden jump or sudden change in the expected growth for Indian economy. So last quarter only we saw almost 10% beat from the expectations on the Indian economy's numbers. So those kind of delivered numbers are resulting into significantly higher demand for power generation. And the supply doesn't come for this sector particularly in a quicker time span. So it takes a lot of time, 1 year, 2 year time lag before that supply sets into the system. And that is giving opportunity to the regulated utility sector where there can be significant opportunity in the power related utilities. So that is another area which we are quite positive on.
Thanks, Sanjay. The next question is to Harshad. Two broad indices, NSE 500, market looks like they will give decent low teen returns over the next 2 to 3 year time frame. Assuming the fair valuation remain, is there enough steam on the earnings front? Looking at NSE 500, do we expect low teen returns for the next 2 to 3 years time frame?
Okay, Saurabh, unfortunately, we can't really discuss or promise, returns. But, the numbers that I gave for earnings growth were for Nifty. For NSE 500, I don't have the numbers with me for underlying earnings growth. But what I can say is that in terms of earnings growth, the expectation is that the earnings growth will continue to be fairly good in the medium term. And I would like to point out that compared to, let's say, till about 3-4 years ago, if you look at a decade before that, we always used to start the year with the analyst expecting mid-teen kind of earnings growth, and we used to end the year at single digit or virtually no growth. So there was a long period of earning downgrades spread over several years, to the extent that for 7-8 years, you virtually had almost zero growth in Nifty earnings. The good change and the heartening thing is that over the last 2-3 years, if you look at it, there have not been such strong instances of earning downgrades. So over the last 2-3 years, I would say that the underlying earnings growth of corporate India, I'm using Nifty as a proxy here, has been fairly good. And if you look at next 2-3 years, also the expectation is good. Also, if you look at the economic backdrop, and I did allude to that in the beginning, is that economic backdrop also is looking very good. I don't think the macroeconomic situation in India was ever better than what it is today over the last, I would say, almost 25-30 years. So there are many tailwinds, and I think Sanjay also referred to a lot of heavy lifting in terms of policy making, in terms of pushing through structural, sometimes unpopular reforms that this government has done over the course of last 9 years. I'm referring to things like RERA in real estate, GST implementation, of course, and also this whole IBC framework. Okay, so if you look at it today, if I can call it that, the balance sheet of Government of India, the balance sheet of banking industry, and the balance sheet of corporate India in general is very, very strong. So I will be, not surprised if the underlying corporate earnings growth continues to be fairly robust for extended period of time. And that is a big difference compared to now versus before. Because previously what used to happen is that because we, never really focused a lot on the supply side, anytime the demand growth improved, we had a situation where the inflation, used to come back in a big way, and that would put a brake on the overall growth cycle, because then RBI is obliged to act to tamp down on demand growth. The difference now compared to previous episodes is that I would say that the structural or sustainable rate of growth of Indian economy is higher than before. And that will have implications for corporate India's growth also, because if you look at it, corporate India is actually a levered play on overall economic growth. So I would say that the underlying earnings growth of corporate India will continue to be fairly good, and with the flow dynamics that I talked about, that both domestic investors and foreign investors are likely to be positive on Indian equities. Foreign investors also, because India currently stands out as a rare big market where there is a lot of positivity. I will say that the market returns could potentially be higher than the underlying earnings growth that we will witness over the next 2 to 3 years. I hope that I can't really quantify it, but I hope it addresses what he was trying to ask.
Yeah, thanks, Harshad. So the next question is, what are the plans for the NFO in Jan-Feb-March quarter? So I'll answer that. We are planning to launch a business cycle fund in the month of Feb, and we believe that this is an opportune time to launch such a fund. More details of the fund will be shared in next 10-15 days with you. Harsha, Sanjay, Hardik, you want to add anything on the fund right now? It's too early days, right?
Nothing at the moment, Saurabh. And
the next question is that should we look at a smaller AUM AMC or the larger AUM AMC? I take that. I don't think that should be the filter criteria when you're looking for a fund to advise or sell to your client. Personally, I think what one should be looking at the AMC is, one, what is the investment process of the fund? Are they true to label? And the third is, are they consistent? So personally, I would look at these three things rather than looking at the AUM size. Yes, in certain category of fund, larger the AUM, it becomes difficult to perform. But frankly, that is not a filter that I would look at. Sanjay, Hardik, Harsha, you want to add anything on that?
Saurabh, I'll just add one thing. I completely agree with you. That should not be the starting criteria. However, as you alluded to, in certain categories, it does become a problem. I will not say it is a problem of the size. It is how the fund manager looks at the mandate. But in small cap category in particular, and to a smaller extent in mid cap category, one should anyway test, irrespective of the size, test the portfolio for illiquid pockets, because when the market corrects, I think that is what that leads to a lot of pain for the investors in terms of performance. So I would say that particularly in small cap category and to a lesser extent in mid cap category, do test the portfolios for illiquid pockets, and that is an analysis you can do from publicly available information. It's not a rocket science. It's very easy to do. If you have any questions on that, please do get in touch with your relationship manager from Union AMC, and we will be able to help you with that.
Thanks, Harsha. The next question is on the team strength of Union Mutual Fund. So if you look at it, we are overall 340 employees in Union Mutual Fund. From a sales perspective, we are present in more than 125 locations. There are another question on what is our percentage of the AUM is from Maharashtra. So if you look at the overall AUM, our percentage from Maharashtra is 27%. But if I look at only equity and hybrid category, our percentage from Maharashtra is at 22%. So we have a much wider B30 and retail base compared to the peer group. Then another question on the regulatory side, Pradeep, if you can answer that. What would be the major challenges faced by the AMC in the coming 2 to 3 years regarding the TER expenses, etc.? I think we lost Pradeep for a moment. We'll come back to the question. There's another question on the value fund. Looking at the current valuation, is it a good time to start recommending the value fund to clients?
So
Is it audible to you?
Yes,
Yeah.
you are audible.
Sorry. Yeah. So on the value category, we take a slightly differentiated opinion. We think that value category should be seen from the context of the risk analysis of the investor. If it is making sense from that investor's portfolio perspective, I think value makes sense across the market cycles as well. Because value has 4 buckets as such. If you look at our product note, which would have reached you, we look at value category from absolute value, relative value, and there is a special pocket for special situation and turnarounds, which we have taken special exposure in. So this provides a differentiated flavor to the investor when they are looking at the value category. So special situation as well as turnaround are considered to be big value unlockers for the investor over a period of long term, 3 to 5 years, from 3 to 5 years perspective. So that allocation we try to allocate special dedicated allocation in the value discovery fund to the extent of 20%, and balance allocation is in the for the absolute value as well as the relative value buckets. So that is how we are looking at the value product when we are looking to allocate in the value category as such. So this is not a I don't think one should look at this fund at a specific timing in the market, but this should be this can be considered across the market cycles irrespective of the valuation at which market is trading.
The next question on that, with the inclusion of India in the JPM bond index, what impact will it have on the equity markets?
Yeah, I will attempt to answer that question. So, frankly, the bigger impact will be on the fixed income market, and I'm sure you know about it. But what it does is that it actually improves the attractiveness of India as a destination on an overall basis. As you know, that it has not just been included in the JP Morgan bond index, but subsequently, I think Bloomberg also has added it in their emerging markets bucket. And the next step could be that it being included in the overall global bucket, which will mean that the amount of money, extent of money, we talked about the FII money coming into equities, but clearly the FII money that is coming into the fixed income market will also increase. And although these changes are set to take effect in the middle of this year, we have already seen impact of that in terms of flows coming in already. And we saw decent flows in the debt market over the course of last 4-5 months as a result of that. So clearly it's positive. I don't know when it will happen, but the next logical step could be, because it's I highlighted several times that India looks like a bright star in the world today in terms of growth as well as in terms of improvement in the balance sheet of the country. The next logical step could be, although nobody knows when it will happen, is the upgrade in the rating for India, sovereign rating. So what this indicates is that India becomes a sort of a mainstream market for global investors. And as a result of which, what I would expect is, of course, that creates a problem for RBI, because how will they offset that flood of money that will come into India? Also, I don't know whether you saw that comment. I think it was from Sanjeev Bajaj, if I'm not wrong, in Davos, where he talked about a flood of money coming from FDI also into India. So essentially what it means is that India suddenly becomes a very attractive market both for institutional investors, both on the equity and debt side, as well as for the direct investment into plant and machinery, that obviously creates complications for RBI, the way they want to manage currency. But overall, it is a sort of a stamp of approval by the foreign investors. The other point which I should have alluded to was that from a foreign equity investors perspective, the emergence of domestic investors as a category is actually very positive. Because previously I know this firsthand, that foreign investors always used to worry before committing large amount of capital to Indian equity markets, because they were always worried that when time comes to sell, who is going to buy it from us if the amounts involved are in billions of dollars. However, with last 2 years of experience, I think they are comforted that there is going to be somebody on the other side if we wish to sell large quantities of stocks in India. So that will encourage foreign investors also on the equity side to commit larger capital than they have committed before on an annual basis. So all this, I would say, is an improvement of perception of India as a country, and what it will also do with the coming in of money, and hopefully potentially at some stage increase in the rating for India, is that overall cost of capital for Indian government and Indian corporate sector will also come down. And that, of course, has consequences for, overall growth, viability of projects improving, and so on. So it will lead to a virtuous cycle of, fundamentals as well as improvement in perception.
Thanks, Harshad. So the next question on the PE. So the question is that in last 10 years, the corporate earnings have gone up. So isn't it a mistake comparing the PE with the historical PE? And the follow-up question is that we have seen a decadal run in the China and US market, whether it was also run by the manufacturing theme when the markets took off over there. So were they also playing the manufacturing theme at that point of time?
So, I'm not sure whether I've understood the second part of the question, but let me deal with it anyway. The first part of the question is on valuations. Can you just remind me what the first question was?
So the first part is that if you look at a historical P and compare when the markets are cheap or expensive, but also what has happened, the levels of earnings are going up. So isn't it that the average already has moved up and there can be new peaks in the future?
Yeah, so it is always hazardous to compare returns or valuations at the index level, because frankly the index composition itself keeps changing. So the index composition 10 years ago, 20 years ago, or I would say even 5 years ago, materially changes, and therefore the underlying let's say return on equity of businesses also keeps changing. And to that extent, I will not say that comparing historical valuations to current valuations and saying whether this is expensive or not is not sort of perfect science. You have to keep an eye on that as a reference point. But, just because it is appearing expensive compared to the past does not necessarily mean that it is very overvalued, or vice versa, because the complexion, and as you know, if you look at big buckets of sectors, BFSI, if you consider particularly, let's say, lenders, the return on equity will not be as much as what it would be for another big bucket of IT services, where the return on equity tends to be higher. So the complexion change will mean that the right or the fair valuation for index itself will be different now versus different 5-10 years ago. So it should be used as just a reference, as one of the many things. The more scientific way is to look at the fundamentally driven fair value, the way we calculate based on future outflows or future cash flows. That's I think the right way to do it. Coming to the second question, yes.
Can I rephrase it, Harshad? I just asked the question again.
Yes.
So the question is comparing the US and China 10-year bull run and how manufacturing played a part in that. And during that bull run, the P remains elevated for a longer time, the P multiples. But the run happened, and are we in a similar position for next 10 years?
Okay, so firstly, in the premise in the question, I'm not sure whether there is necessarily a cause and effect relationship to manufacturing. The fact of the matter is that when you saw a long run for significant economic growth in China, it was driven by manufacturing, because essentially after accession to World Trade Organization, China became, and the other big geopolitical changes in early 90s, China became factory of the world, right? There was a large scale shifting of manufacturing capacity to China. That was also the time when the Chinese growth rates, economic growth rates, were significantly faster, and China became, at least in the first decade, an attractive market for investors. Now, in case of India, yes, it is a fact that we will see some kind of a resurgence of manufacturing, but I don't expect it to be anywhere close to what happened in China in the early 90s, because the model that India has is going to be very different. Those were different times. So in India, yes, importance of manufacturing in an overall scheme of things will improve. But remember that if you look at the overall economy also, services sector plays a much bigger role in India today. And what gets missed from people, and I have this sort of constant conversation with my colleagues on the fixed income side. In the trade statistics that comes out, people still focus a lot of attention on current account deficit in the context of merchandise exports, goods exports and imports. I think the story that gets missed is the extent of surplus that we have on the services exports minus imports. So I would say that, manufacturing will become more important than before in India, but it will not be anywhere close to what China witnessed in the first decade of 1990 to 2000. But that is not a precondition for our markets to do well. Our markets can do well because overall economic growth is high. There will be, exports of services will play a very, very important role in the context of India. And the markets can do well without manufacturing ever becoming as important as it was in the case of China.
Thanks. We're coming towards the last 2-3 questions. I'll take them quickly. Is a PSU, PSE, and infrastructure are getting into a stable re-rating rather than calling them cyclical play? So are they a turnaround and they're getting stable, or they're still cyclical by nature?
So I'll take that.
All right.
Yeah, I don't think currently we are in a position to say that there is a structural change, and I'll tell you why we are saying so. Currently we are in a phase where these companies are seeing a very big growth in their business opportunity, and even the return on equities have significantly improved. Now, this has always happened when the economy has gone through a cyclical upturn. To say that this time the upturn is going to be sustained, it's difficult to call out at the outset. We'll have to wait for a couple of years to go by. See once the initial leg of investments come through, the initial leg of capacity expansions come through, we will have to wait to see whether when the initial whatever lending is happening currently, once that book seasons and the credit quality actually stands the test of time, that is when, unfortunately, we will be able to say that there is a structural improvement in things. What we can say is when we talk to industry participants, experts, they are talking about a very different way of governance at the center, and which is now reflected in the management and operation of these CPSE. This definitely has resulted in a difference in multiple ways, and that is why we are seeing not only growth coming through, but even the return on equity inching up year after year. So we are hopeful that that can happen, and if that does happen, there is valuation upside left. But the fact is that whether that is really the case, we will only come to know once a few years have gone and there is enough seasoning of these balance sheets, and we can take that call conclusively.
Thanks, Adik. I'll take the next question, which is on the interest rate. When will India start cutting down the interest rate? So, as you're aware that there have been expectations built up right from the start of 23, where there were a lot of guess taken at when the cycle would change. I would still not hazard a guess on that because clearly that cycle may take longer to turn around. But having said that, in terms of near the peak, yes, we are somewhere near the peak. That's what our current valuation is, that on the interest rate cycle, we are somewhere near the peak. And if you look at it from a perspective of long-term debt, it is a good idea to park some money in long-term debt, because the interest rate cut may happen in 24 second half or 25 first half. This will all play out. But if someone is coming in with a view of 2 years, you have a significant chance of getting a mark-to-market gain along with the currently high approval over there. So products like long-term gilt makes a lot of sense. There's no credit risk over there. You can have the longest duration possible over there. So also, debt funds are not replica for equity. They're all allocation products. So there's a question on which is the best asset class for 24. Really, it can be debt which can outperform equity, or equity can outperform debt. The idea is that you should be present in all the asset class and not miss out the significant opportunity. So currently, like the equity investment team led by Harshad is talking about, Sanjay and Hardik are talking about, that while small mid caps may be expensive slightly, but it's not that we're asking people to shift out from small and mid cap, right? If you're putting fresh money, come through the allocation. Similarly, when you're looking at a debt, yeah, if you're coming in for 2 to 3 years, there's a significant chance of making high accrual and mark-to-market gain. Pradeep, can I ask you the last question for the day before we find
Yeah,
it?
yeah, sure.
Yeah, so there's a question by distributor that what are the more regulations you are expecting from SEBI, especially on the expense ratio TR in next 2 3 years, and how do you see the industry shaping up in next 2 3 years in terms of distributors' perspective?
Oh, well, that's a difficult one.
Which is why I have saved it for the last.
Okay, so I think I'm not frankly expecting any what is a big bang moves from the regulator in the near future, particularly on things like TER, because while there were some very significant proposals that were put forth in the middle of last year, I think the regulator has gone back on that, and they said they would rework. So it's been a while and we haven't really heard anything. But even if it comes out, all the indications that we had from the regulator at that stage was that whatever is a final version would be something that would make the industry happy. So I think we don't really need to worry too much about whether there would be regulations that that affect the industry or industry's growth negatively. I think the regulator is as keen as all of us to make sure that the industry grows and becomes even bigger. Okay, but having said that, there's a few things that we need to accept. The margins and basically the TER is not going to increase. If anything, over a period of time, the margins may even come down, right? Margins will not increase. That's a reality. So let's not expect that TER will go up. It will not go up. If it stays at this level, we should be happy. Okay, but what will also happen is that the industry will grow, our scale will grow. So, if we have 4 crore unique investors today, okay, in a country where there are, I think, almost 12 crore demat accounts and about 12 crore people playing around in crypto, right? Look at the possibility that we have, the room for growth that we have in the industry. This 4 crores can become 8 crores, it can become 12 crores. And that is where the industry is really going to grow in terms of size. So while the margins may remain, I think the revenue for both the AMCs and the distributors, I think will definitely increase for those who are serious and stay in the game with conviction. So the way I foresee this over the next 3-5 years is that the number of investors will increase. Even the existing investors will keep on adding more money. So we will have a lot more scale. It doesn't take much for the 50 lakh crore AUM today to become 100 lakh, that is, double in the next, say, 4 to 5 years or so. So I think we must be prepared for that. And we must be prepared for servicing those investors effectively, using technology wherever we can, and utilize the manual time wherever it really matters for providing the right kind of customized, personalized advice to investors. So I think the future is looking extremely good for the industry. We will remain tightly regulated. That's the nature of our business. That's the way it is happening. But I think that has also made us more attractive to investors. See, today we can say confidently, very confidently to any potential investor that, this is one of the safest industries. Nobody is going to run away with your money. We can say this to any investor. I think, we have to really thank the regulators substantially for giving us that confidence. So I am expecting the number of investors to double in the next 4 or 5 years, the AUM to double or even more. So I think there's very exciting times ahead of us.
Thanks, Pradeep. That comes to the end of our call. Once again, thank you everyone for giving your time for the call. And hopefully we will be able to see you very soon in your markets. All of us will be traveling and would love to hear more from you. Harshad, anything? Sanjay, Hardik, you want to conclude by?
No, nothing. I just want to thank everybody for giving us this time.
Yeah. Okay.
Thank you.
Thank you.